guys, this is Chris Elliott with Remax Action Real Estate coming at you today with another real estate quick tip. Probably not so much of a quick tip. What we're going to be doing today, another long form interview. I've got Mr. Adam Gjerulff of Geneva Financial with me today. Adam is a mortgage extraordinaire, one of our preferred lender partners. And what we're going to cover today, he's going to walk us through the different, kind of the full spectrum of loan products. Everything that's available for, if you're a first-time home buyer, all the way to the investment products they have available if you're looking to buy investment properties. So Adam, first and foremost, thank you for coming on the show. Before we kind of dive deep into the content for today, can you give people a little bit about your background, your experience in the industry, and kind of just a little bit about you?
Sure. Thanks, Chris. Great to be here today with you. Little background on me. I've been doing mortgages for 13 years now, and I've worked on kind of every aspect of the business, whether it's broker or wholesale, working for a big lender. And I'm now at Geneva Financial, as you mentioned. I'm the branch manager here. So I've been doing it a long time. I love doing it, and can help you with any questions you have on the different products available today.
Awesome. Okay. Well, thanks again for being on. So Adam, we talked a little bit about before the show about what we wanted to cover, but so the four groups that we're going to be talking about today and kind of what loan product options are available to them. We wanted to talk about first-time home buyers, and it seems like that the products available are always changing, and kind of there's new products always coming out. We're going to be talking about the second, third, fourth, fifth home, buyers, maybe folks that somebody already owns a home. You're looking to upsize, you're looking to downsize, or you're just looking to make a lateral move. We want to talk about loan product options for self-employed folks like you and I, and then also for what kind of investment products are available in the marketplace today. So let's start off with a first-time home buyer. Let's cover the basics. What are the typical products that you always see out there? And then maybe share with us some of the new products and kind of some of the pros and cons of each.
Sure. So first-time home buyers, basically the biggest thing I always talk to people about is credit score. They don't really know how much the credit's going to affect the options available for them. So that's one thing you want to do if you're thinking about buying a house. Look into your credit score. You can use Credit Karma and do what you can do to get the highest possible score. The most prevalent options out there are the FHA option and the conventional option. With the FHA, the minimum down payment is 3.5%. Conventionally, it's 3%. With Home Ready, it's impossible. The conventional product, as you probably know, Chris, is a better product long term. FHA is still a good loan. There's just some pros and cons that we can discuss, on which option is better.
Yeah, absolutely. And I'm having a little trouble hearing you, Adam. I don't know if we wouldn't need to put in like earbuds or whatever, but so let's talk about the basics. Let's get into FHA, the 3% conventional. Kind of run us through the basics of that process. Pretend I'm somebody that doesn't know anything, and I'm kind of just starting in this process.
Sure. So with the FHA product, the minimum down payment, like I said, is 3.5%, which is nice for first-time home buyers. I think the biggest con about FHA is the mortgage insurance associated with it. Mm-hmm. So with FHA, there's two ways you're paying the mortgage insurance. The first is an upfront premium, which is 1.75% of your loan amount. So for example, if it's a $100,000 loan amount, you're paying $1,750 off the bat. And in addition to that, it's 0.85% monthly. So that's basically the insurance pool that FHA has for loans that default. So that's basically insuring them against people getting a loan and not being able to pay for the loan. FHA is a good option for somebody who doesn't have the best credit score, maybe, and they don't really have the availability to get it up before they get the loan. Again, it's a great product. It's there for a reason, and it's good for first-time home buyers. Get your foot in the door. One of the negatives about the mortgage insurance associated with FHA a couple years ago, they changed it to where as long as you have that loan, you have that mortgage insurance. So you either have to refinance or sell the house to get out of the mortgage insurance.
There's no way to get rid of that mortgage insurance.
Exactly, without refinancing or selling the home. So that's a big con associated with it. On the other side, the conventional products that have come out recently you only have to put 3% down. You can have as low as a 620 credit score to get these loans. And the mortgage insurance on these, just like every other conventional loan, does go away once you get that 22% equity in the property.
Cool, cool. And are there, and like I said, I know there's always, especially for first-time home buyers, it seems like there's always like a new hot product out. But are there any other products that folks should be aware of for first-time home buyers?
I mean, these are the basic products there. I think what you're alluding to is down payment assistance programs.
Okay.
So a lot of different down payment assistance programs available. It really depends on your locality, your income. The down payment assistance programs are capped on your income, and basically how you structure the loans. So VHDA is very popular here in Richmond. With that product, it's based off your household income. So whether somebody's on the loan or not, if you have husband, wife, and child works, you have to show that child's income for qualifying. So really depends on everybody's personal financial situation on what they're going to qualify, what grant program may be available for them or not.
Beautiful. Okay. All right. So let's transition a little bit then. So let's talk about, we chatted a little bit about first-time home buyers. What are typically the options that you're reviewing with somebody that, maybe they're getting into that second home, or, they're downsizing, they've got some equity, they've got some cash, maybe just a first-time home buyer that's got more money saved up. What are you typically reviewing other than just your standard vanilla, 20% down conventional loan? What are the things, what are those folks looking at?
Well, that home ready product that I just spoke to you about, that Fannie Mae product, you actually don't have to be a first-time home buyer, which is really nice. Big advantage of this product is it's income based, but it caps you out on your adjustments. Conventional loans have what's called loan level price adjustments. So those are adjustments to your interest rate and to your mortgage insurance based on how much you put down, what your credit score is, etc. With the home ready product, there's a cap on that. Again, a lot of people are not aware that this product's available for them as a second-time home buyer and third-time home buyer. So you can put, again, as little as 3% down. A lot of those people are putting 5 to 10% down because that will affect your interest rate and your mortgage insurance. So obviously, the more you put down, the better for monthly payment and for your interest rate. But I do my best to try to fit somebody into a conventional product if we can. If the credit's not where it needs to be right now, a lot of times there's some simple things we can do to increase the score, like pay down a credit card to zero balance to get them where they need to be.
Yeah. And, along those lines, I mean, one of the things I know I'm always telling people, and you tell me if you agree or not, I always tell people, hey, if you're even thinking about buying a home in the next 12, 18 months, it probably makes sense to start the conversation with a good mortgage lender, just because if there are little things like that where you can tweak your credit, bump it up a couple points, pay off some debts, or save a little money to get into a better product, it's hard for us to do that as real estate and mortgage professionals when folks come to us 2 weeks before they want to do something. But if they can engage you 6 plus months out from the process, I'm sure it becomes a lot easier to do that. Would you agree?
Absolutely. And a big thing, especially with first-time home buyers, are little things that you would know if you bought a home before, but that you wouldn't necessarily know if it's your first time. For example, closing costs, the different inspections and appraisals that need to be done on the property prior to closing, which, as you know, that's about $1,000 that you're spending. So a lot of people think, well, I have to put 3% down on a $200,000 house. That's $6,000. That's what I'm going to need to close, which just isn't the case, as you know. Closing costs are 2 to 3%. And to your point on the credit and getting yourself in a best situation to buy, I mean, the earlier the better. There's a lot of times where it can take as short as 30 or 60 days to get somebody's credit score up 60 or 80 points, which over the life of your loan could save you tens of thousands of dollars in interest. So it's always a good idea to talk to a mortgage lender sooner rather than later.
Yeah, absolutely. And real quick, before we move on to self-employed and then also to our investor friends, what was that one change you were telling me about the other day? I know sometimes folks like to keep the especially if you own your first house and you're looking to upsize and moving your forever home, or the home, you plan to spend the next 15, 20 years in, a lot of folks want to keep that first home as a rental, which is a great way to build wealth. What was that change you were telling me about the other day where I guess the guidelines on the mortgage, or what was that, what we were talking about?
Yeah, so that's with a conventional loan. Previously, if you were moving out of your primary residence to buy another primary residence and your plan was to rent the old home, they required you to get an appraisal and prove to the lender that you had 25% equity in that property in order for you to be able to use that rental income as qualifying income. In the last couple of months, they changed that. So all we need now is an executed lease, deposit check, and then the first month's rent check paid like you would in any other lease. Once we get that, we can use 75% of that lease amount. For example, if it's $1,000 a month, you can use $750 as income to offset your mortgage on your current home, which is opening up a lot more people, like you said, to, instead of selling their property, if it's the first home that they bought and they could get some decent cash flow on it, they can actually hold on to that property, move up, buy the next house.
Yeah. That's awesome. I mean, it's a great way to build wealth. Okay, cool. So we talked about those folks, our self-employed friends, myself, yourself. I know, we run in a lot of the same circles. We deal with a lot of entrepreneurs. What's available for those folks, and not only what's available, but what are the common mistakes we see people make? What do those folks generally have to do to get themselves in order to purchase a home? We're a little more complicated than your average W-2 employee. Speak to that real quick if you can.
Sure. So self-employed individuals, like like I know, our goal is to pay as little tax as possible, right?
Amen.
We want to get a CPA. We want to write as much off as we can. I don't want to pay income tax. So what's happened over the last few years is, I'd say from 2009 through 2015, 16, a lot of those individuals haven't been able to get a mortgage because they have good CPAs, they write everything off, and when they go into a bank to apply for a loan, they're looking at adjusted gross income of $20,000, and the individual's trying to buy a $400,000 house. So that's not going to be.
Having trouble hearing you a little bit.
Nope. So the individual walks into a bank to buy a house or to get a loan, right? And their AGI, their adjusted gross income on their tax return, shows $20,000, and they're trying to buy a $400,000 house.
Yeah.
And the bank's not going to do that. So what's happened over the last couple of years?
Just to interrupt you real quick, to explain for my folks and my friends that, maybe you work at Capital One or, your W-2 income. So you take the guy that's making, realistically is making $100 grand, $200 grand, whatever you call it, has a ninja CPA that shows that, he makes the same amount of income as the guy sleeping under the bridge. He's paying nothing in taxes, but he can afford a $400,000 or $500,000 house. But the problem is when he goes into a mortgage professional like yourself, he's showing that he makes $20,000 a year, and it doesn't matter how much cash you can show a lender. They've got to see on paper that you can afford the house. Is that kind of
correct? And that's what it used to be. So now we have some more creative products on the market and creative underwriting for those self-employed individuals. What we're doing now is we're using an individual's bank statements. So we know they're not going to show much on tax returns. We don't even want to look at the tax returns on that type of individual. We actually ask for either 12 months of their personal statements or 24 months of their business bank statements. And we take an average of those either 12 months or 24 months. We actually use that as income. Now, we know there's expenses associated with that income, and we'll see them on those bank statements. And we can actually get a profit and loss statement from the business owner, or we can get a CPA letter stating what those expenses are. But I've done several over the last year that the individual on their tax return shows no income at all, and we're able to get qualifying income for them for $10,000, $15,000 a month, because that's what they're really making.
Right.
They just happen to have good CPAs.
Yeah. Now, just out of curiosity, do the interest rates tend to be a little bit higher on those kind of loans?
They do. So with every self-employed individual that I talk to, I do ask to see the tax returns because there are some items we can actually add back for income. So if
Okay.
we can get you qualified for a conventional loan, that's the best route to go. The interest rate on the bank statement loans are typically 1 to 2% higher than a conventional loan, so it's nothing drastic.
Yeah.
And compared to what individuals were doing in the past to get loans, let's say 2012, 2013, I mean, I can't tell you how many people I talked to who I would talk to, you know, in 2012, tell them they don't make enough income. In 2013, their accountant decides to actually show their income, right? But what they end up doing is paying the IRS a ton more in tax
Yeah.
just to get a mortgage.
Yeah.
So if you look at it that way, yeah, it's more expensive interest rate wise, but it's a lot cheaper than paying the IRS.
Yeah, so I guess it's something, if somebody's in that situation, they come to you, then you've really just got to run the numbers and look at it and say, am I better off, you know, paying Uncle Sam and getting the cheaper rate, or does it make more sense for me to keep my money and just pay the higher, you know, interest rate on the loan? I guess it all just becomes a numbers game at that point.
Exactly.
Yeah. Okay. All right, cool. And then last but not least, investment products. What's available? What's out there? If somebody's looking to, you know, either buy some rentals or they're looking to flip properties, kind of what do you have? What's in the market? Talk to us about that.
Again, that part of the market has opened up a lot over the last couple of years. We have a ton of different investors with some pretty off-the-wall products on that. One that I'm looking at a lot for individuals is the debt service coverage ratio loan. So what that means is basically we don't look at tax terms, we don't look at your income, we're looking at the property itself, what the appraisal shows for the market rent on that property. And as long as that rent will cover your principal, interest, tax, and insurance payment on that property, we'll do the loan for you. So it's basically we're only looking at that property. We do look at the individual's credit score. You have to be creditworthy. But that's something that's very new to the market, and it's needed, if you ask me, because investors, just like we were just talking about, are self-employed, right? So they typically have a lot of write-offs associated with their tax returns, and the capital isn't available through conventional financing.
Cool. I mean, that sounds a lot like what you typically see. We'll see on a commercial loan, where it's not as much like they're looking at the investor to see a track record, but it's really more based on the property and its ability to perform more so than the borrower. Would you agree with that?
Exactly, and that's a term associated with commercial mortgages, the debt service coverage ratio. So you're exactly right there.
Cool.
If you think about an investment property, it's commercial in a way, right? It's a business.
It is.
It is a business in itself.
Yeah. Okay. And anything else available out there to investors, or anything else that folks should know or be aware of?
Yeah, one thing with investors with a big portfolio, Fannie Mae, the conventional options cap you at 10 investment properties with mortgages on them. That's still the case, but there's a lot of, we call them non-QM investors out there with very good rates, very competitive rates, who are allowing individuals to go 15, 20, or 30. Another option out there, which hasn't been the case the last couple of years, is you can actually buy the properties in the name of your LLC. You're still personally guaranteeing the loan, but most banks and most lenders require you to purchase that property in your name, not an LLC. So that's a new product that a lot of people are interested in.
Yeah, that's awesome, because I know the one thing that when I'm talking with investors, they don't want to buy parcels in a property name for liability reasons, for privacy reasons.
Right.
So that's awesome. And also too, on that 10 cap on the mortgages, and I know you said some investors are going to 15 or 20. I've heard people say that, hey, you know, put 10 properties in your personal name, put 10 in your wife's name. You know, is that something that can be done?
Yeah, absolutely. You know, that's 10 for that individual. So that's a way to do it. Again, if you actually get the properties in an LLC as well, and they have a commercial loan on them, then that doesn't count. So it just really all depends.
Cool. Well, Adam, I appreciate your time today. I mean, I know we could probably talk for hours on this stuff, and you know, we were talking the other day. I think there's definitely some more shows we could see, but we appreciate your time, appreciate that information, appreciate you going through it with us. If somebody wants to learn more about what their mortgage options are, what's available to them personally, or they just want to chat with you, they'd like to do business with you, where can people find out more about you or get in contact with you?
Yeah, thanks for having me, Chris. My office number is 804-299-5408. Again, it's Geneva Financial RVA. We're located right next to Willow Lawn here. My email address is simple. It's adam@genevafy.com. And our website is genevafy.com/RVA.
Cool. And what I'll do is I'll link that up everywhere we're posting this, whether you're seeing it on social or YouTube or email, whatnot. We'll make sure we get that information in there. So, Adam, appreciate your time today, and look forward to talking with you soon, buddy.
Thank you, Chris. Have a great day, man.
All right, we'll see you.